So now, without further ado, I'll hand over to our first speaker of the day. I'm pleased to welcome Ravi Balakrishnan, who is Chief European Economist for JP Morgan. He has a hugely impressive CV, having spent over 20 years at the IMF with various postings around the world, including Washington, Peru, Bolivia, Sri Lanka, and Singapore. He'll provide a global macroeconomic overview entitled Narrow Path to a Soft Landing, and hopefully will share his view on whether he thinks it's a path that can be successfully navigated.
Thank you, everybody. Pleasure to be here. Hopefully we can have this will stimulate you a little bit, and we'll see what kind of questions we get at the end. I'll make sure there's enough time for that, given the, as Andrew was saying, it's a consequential day today with the Fed making its decision on whether to cut 50 or 25 basis points to start off the interest rate cutting cycle. So as Andrew mentioned, this is really about, I'm going to give you a helicopter view of how we see the global economy, focus on the US, China, Western Europe in particular. And a key question really is, are we going to get a soft landing or not? I think that's where I'll start off. Since the pandemic and the war, there's been a lot going on. We use the word unprecedented very often, but they are unique shocks in a way, or rare shocks. And so you've also got structural changes going on at the same time, demographics going in reverse in Western countries, the various transitions that we talked about that Andrew mentioned. So there's a lot going on. And so within that, you've got cyclical developments, structural developments. It's hard to think of a very clear baseline with a really strong degree of conviction. So we've been running with various scenarios, probably since early 23, and you can probably broadly split them into two camps. Soft landing, and I'll go into different scenarios for that, and then boiling the frog, which is really your harder landing, a recession scenario. So we've changed the probabilities. They've moved up and down, so I wouldn't put too much weight on the specific numbers, but broadly speaking, we've been moving up our soft landing probability, so it's now around 55% over time. The boiling the frog has been a little bit below 50s, moved up and down. I mean, I think in 23 there was a lot of concern about recession risks in the United States. They started to come back again a little bit. So because they've started to come back, a lot of it's focused about the US outlook and how it spills over to the rest of the world. Our recession probabilities now for the second half of 25, the second half of 24, have gone up from 25% to 35%. So it's a slight increase. It's still obviously the soft landing is the modal scenario, but we do think there's a bit more risk associated with labor market developments, particularly in the United States. But overall, our probability of recession by the end of 25 hasn't really changed. It's still around 45, just below 50%. So I mean, it's still quite a lot of time to end of 25, and in normal times there is still usually a reasonable probability of recession priced into markets. But ultimately, we've changed our near-term risk bias in terms of a slightly higher probability of recession, but not a recession by the end of 25. So within these scenarios of soft landing, you've got the immaculate disinflation, which is your really rosy scenario where rates are cut pretty rapidly in the US, in Western Europe. You get inflation down to 2 by the middle of next year on a sustainable basis. And you don't get much of a correction in terms of growth. So growth remains reasonably strong. The other scenario is a little bit reflecting that maybe potential growth has gone up. You've got all these big investment needs. So the real interest rate, the neutral rate may have risen. So you can still get reasonable growth, inflation coming down, but the interest rates will be a little bit higher for longer. They won't come down as quickly as in the immaculate disinflation scenario. But growth is still reasonably strong and maybe at trend or above trend. Then the boiling the frog scenarios, there's the wait for it, which is similar to the high for longer of a soft landing, but interest rates stay high for a little bit longer. So you may get some cuts, you may get a little bit of a long period where rates do not change, and that eventually leads to margin compression of corporates. You start to see adjustment in the labor market, employment destruction. You get your typical recession dynamics as consumption starts to tank. Now, the other scenario, which is, we would say, less probability is attached to it now, is a too darn hot scenario. This was getting a bit of play a couple of months ago when we saw consistent prints of high core CPI in the US, and there's this concern about whether that's going to flag core PC also rising. So at that point, people were worried that maybe the Fed is going to have to hike again. I think those kind of concerns have come off quite significantly, so I wouldn't put too much weight on that scenario. It's not totally ruled out, but it's a low probability scenario. So that's basically how we see the global outlook. So in some senses, both scenarios are still in play. There's a little bit of observational equivalence about the data that we see, and it could be consistent with both of those scenarios, although overall, we do see a high probability of a soft landing with some concerns about the labor markets, in particular in the United States. So let's turn to the US. So the US really has been doing extremely well. We've had much higher than 2% growth over the last year or so. It's starting to decelerate, but in some ways, the key question is how quickly will it decelerate? Will it eventually stall or not? Currently, the tracking for Q3 looks pretty good. Our forecast is 1.5 for Q3, but the tracking is actually higher than that. I think the Atlanta Fed nowcaster is at 2.5. So, I mean, overall, retail sales was also strong. So developments in the US in terms of overall activity look good. And you had very strong consumption, which I'll come on to in a second, but you've had overall strong domestic demand. Fixed investments been doing generally pretty well. Structures was going up significantly in 23. The growth rates come off a little bit since then. There was a big impetus from the public sector, particularly in 23. We had a deficit of 8%. There's very strong government consumption. Some of that stimulus is starting to come off, although there's still a little bit of uncertainty about how state and locals will spend going forward. Now, one big difference when you compare to Europe really has been the US consumer. They've been spending. They've been spending actually above their real income gains, and so their savings rate has been coming down, which is what you see, if you can see it, in the upper right-hand chart. So that's a big difference when you compare to Europe. Now, one important driver of that is not just the real disposable income gains, but also that wealth has actually gone up. Financial assets valuations have gone up. Housing wealth is still high. I mean, prices really haven't corrected much, even though housing investment's gone down. So overall, when wealth is higher as a percent of income, then typically you can afford to save less. The other key thing is that despite the interest rate rises, as you see in the lower left-hand chart, the actual debt servicing ratios really haven't moved up that much, relatively speaking. So they've moved up, but if you compare to, say, the GFC or in the 80s, the debt service ratios are much lower because the degree of fixation in particularly for consumers is very high. A lot of people have 30-year mortgages. The share of 30-year mortgages went up significantly before the pandemic because interest rates were so low. So the refinancing wall, at least for consumers, you don't really see that hitting. What you do see is very low housing activity because people can't afford to refinance their mortgage right now. So they're waiting as a wait-and-see approach. Now, as I was alluding to a little bit earlier, one concern is really about the US labor market and where it is. We had very strong payroll growth up until quite recently. You can see that in the upper hand side chart, US private payroll growth has started to decelerate quite rapidly. And there's been some revisions, and if you take those into account, it does look like you're getting close to potentially what's called the stall speed for the United States, which is US employment growth averaged over 6 months below 1%. That typically has been a signal of, often it's difficult to predict whether you can stay at that level or whether you're going to decelerate very rapidly. So I think that's the point of where we're at now and where people's concerns are. And if you look at hiring and firing rates, they've both been coming down quite considerably over the last year or so. So you're seeing it's certainly a significant normalization in the US labor market. The question is, will it go further or not? And so related to that, there's been a lot of discussion of the SAM rule. Claudia Sam is an economist who's written about triggers for recessions. And her rule is that if the 3-month average of the unemployment rate is 0.5 percentage points above the low in the previous 12 months, then that's a sign that an recession will be on the way. And it's often been a fairly good predictor if you look at the table of previous recessions, although she herself has not dismissed the signal this time around, but made clear that it's not. You got to take into account the fact that some of the increase in the unemployment rate in the United States has been driven by increases in participation, increases in the labor force. There's been significant migration, as we all know. Undocumented migration has been a big part of the increase in the working age population in the United States over the last year or so, and that's created this increase in the labor force that we've seen. So, and that's part of the reason behind the unemployment increase. So far, we've not seen a significant increase in layoffs, which is what people are focusing on in terms of whether the labor market is really turning or not. So, some concern about the US labor market. Key question, will it just simply stay at this? It's just a mid-cycle slowdown, or will it eventually go into recession? Now, one obvious real wild card is the US election, and what it can mean. That's going to be incredibly consequential. As we see it right now, it's a toss-up. It's going to come down to the same swing states as always, the 7 swing states. I mean, there's a lot of focus on Pennsylvania right now in particular. So it's hard to predict. But what we can do is at least think about scenarios of whether there's a Trump victory or a Harris victory. And it can make a big difference also to whether if Trump does win, whether he gets a clean sweep, i.e. control of the House or not. It looks like Senate, it could well flip to the Republicans. Control of Congress may depend a little bit more on who wins. In particular, there seems to be a path for Trump, if he does win, to get control of Congress as well. So if there's divided government and Trump does come in, there's still significant actions he can take by executive orders, including tariffs, including on migration, and including on regulation, deregulating further oil and gas exploration, for example. So one big concern is obviously tariffs coming in. It's pretty clear if he does come in, there will be some escalation of tariffs and increases. There will be negotiations, clearly. So we don't know whether the numbers people have talked about now will actually manifest themselves, i.e. a 10% tax on all goods imports to the United States and a 60% tariff on Chinese imports of goods. Now, this can make a difference because in the previous trade war that we saw, there was a significant slowdown in activity globally, and we see this, if you can, in the lower left-hand side chart. The orange line gives you manufacturing future output, which went down quite considerably, and also the oil industry output went down quite considerably around the time of the trade war. So trade policy uncertainty did lead to a deceleration in activity. So this trade wars can and will have an impact on overall activity. And if you dial up these tariffs, I mean, the previous tariff wave in 2018, 2019 was about 1.8% of imports as a share of GDP for the United States. So the total cost as a share of GDP was around 0.4%. Now, if you add up the other elements he's talked about, 10% tax on global goods, 60% on China, that's going to increase that amount by 1.4 additional percentage points. So it's going to be about 1.8% of GDP. So that's not a small number. So it can have an impact on overall consumer incomes and activity. I think that most people are more concerned about the inflation side for the US and activity in areas like the Euro area, which is more closely aligned with the overall global manufacturing cycle. So for Europe, a little bit more concern on the output side. In the US, a little bit more concern on the inflation side of the impact of tariffs. Now, immigration, obviously, if you do put the brakes on immigration in a very abrupt way, that will have a significant impact on overall activity. We've seen a big boost to activity in the US related to this, so that will definitely have an impact both on inflation and output in the United States. On the regulatory side, further deregulation of oil and gas exploration, that will have an impact. But it's also true that the US has been producing at record levels consistently for a while, so the delta on that may not be felt for quite a while. Even Biden, when he froze further consideration of new LNG potential sites, it does make a difference through the end of the decade because you've already got a lot of LNG coming in over the next 5 years or so. So it's more about the next decade, I would say. Now, the other thing which is important is really what happens on the fiscal side. So what happens on the fiscal side, whether they can renew some of the provisions in the TGCA of 2017, in particular some of the income tax cuts, depends on having control of Congress. But you need a new act, otherwise they will sunset. Now, both parties do not want to have an abrupt adjustment. Trump obviously will probably, has mentioned various other taxes that he wants to cut and using the tariffs as the other source of revenue. But will it make a big difference to the US fiscal? It's unlikely to lead to further US fiscal expansion. What it will do is mitigate the degree of contraction which will come in if the TGCA naturally sunsets. So it's not necessarily going to lead to a worse US fiscal situation, but it won't necessarily lead to a much better one. Okay, let's quickly talk about China. So China is really going through difficult times. Domestic demand has been weak. They've been exporting deflation, which has helped actually disinflation in many countries, particularly on the goods side. And you've got if you look at the right-hand side chart, you see really a big divide between public fixed investment and real estate investment, which are on two different trajectories. So public investment has been holding up overall investment in China. Private fixed investment has been largely flat, and obviously there's been a significant correction still ongoing in real estate in China. So near term, we still expect growth to be close to 5%, a little bit below the government's target this year. Although obviously, if that's really under risk, it's quite likely that the Chinese government will take more measures through the rest of this year. Now, what about the longer term picture for China? Well, the longer term picture is that growth has been decelerating from extremely high levels. Some of this is driven by demographic changes, which is the right-hand side chart. The growth of new workers is going into negative territory. China is aging before it becomes rich. Unemployment for youth is high. And in particular, I'll draw your attention to the lower right-hand side chart, which is about China's potential growth. This has come off quite considerably. I mean, our estimates are now that it's going to be between 3 to 4% going forward. So labor will actually be a drag now because of the aging process and the decline in workers. And one big change has really been the revision in TFP, partly because of the clampdown on tech, partly because of the geo-economic tensions as well. So overall, China's prospects in terms of driving the global economy clearly are, it's not going to be as much of a delta as it was in previous decades. Now, what about Western Europe? There's been a lot of focus on Western Europe this week, and particularly the EU. The Draghi report on competitiveness in the EU came out last week, still making a big splash. And related to this is really about the question, is Europe being left behind? And cyclically, it's clearly the case that there's been a much stronger recovery in the United States. We see this very clearly in the left-hand side chart, which is the overall level of output relative to the pre-pandemic trend. The US is the only zone where it's above zero. What's been driving this on the production side is labor productivity, which is the right-hand side chart. You see that US labor productivity has been extremely strong cyclically, whereas in Western Europe, it's been extremely weak. We've had negative productivity growth for quite a while. It just turned positive in the Euro area in Q2. And as you can see over the longer term horizon, you've had divergence in productivity between the US and the Euro area. And you've also had much higher levels of investment in the US relative to the EU. We exclude Ireland because Ireland really does mess up the statistics and the comparisons. So the Draghi report and some other reports, the Letter report, which came out earlier this year, they've been very much focused on how can you drive growth in the EU. And it's hard. And there's various areas. Tech is one area. Tech investments have been a lot lower. Draghi mentioned that tech is one of the big differences in terms of productivity between the EU and the United States. So there's focus on that. There's focus on trying to leverage more private capital via trying to give a big push to capital markets union. And there's also consideration of how to confront the challenges of the IRA and the CHIPS Act in the US and China's subsidies to its industries because it's more fragmented in Europe. So how do you try to combine industrial policy with their existing state aid policy, which tries to keep the integrity of the single market by creating a level playing field? So these are really hard discussions and will be the focus of the Commission and the the new parliament over the next 5 years. But there are big challenges. Within Western Europe, the euro area is a big contrast to the United States in that consumers haven't stepped up. Consumption has been very weak. And you can see this in the upper left-hand side chart that real spending, the blue line, is below real disposable income growth, which has turned significantly positive. People are still saving. There's a degree of precaution in people's activities, partly, and you can explain it. You've got war on the doorstep. You've had a massive terms of trade shock. Energy prices have come down, but they're still high. Retail prices for energy is still high. Mortgages will eventually reset. So, degree of fixation has also increased in Europe, but it's still quite low. So people are preparing for these events. So there's still a significant degree of caution in behavior. Consumer confidence, which is in the lower right-hand side chart, the blue line, has been increasing as inflation has come down, but it's still significantly below historical levels. So confidence is still weak on the consumer side, and you've got weak consumption dynamics, and that has to change if European growth is going to pick up and maybe maintain a rhythm of around 1% or potentially above. Another issue which we look at is monetary transmission starting to fade. President Lagarde mentioned this also in a press conference last week. The delta of the high interest rates is starting to fade. And we can see this in that bank lending, although it's still, growth rates are very low, upper left-hand side chart, is starting to turn. Lending standards are also not tightening anymore. So it looks like the credit cycle is going to start to turn very soon in Europe. Labor markets is the flip side of productivity. Weak productivity has meant that you've had extremely strong employment growth in the euro area. This is one big contrast for the US. In the US, unemployment started to pick up. In the euro area, it's still a historical low of 6.5%. So the labor market has been one beacon of light, in a way, in the euro area. Significant increases in labor force participation, tremendous employment growth, but it is a flip of very weak productivity performance. So in terms of inflation, you've had significant disinflation in the euro area, even despite these tight labor markets, as energy and food price inflation has come off quite considerably. So you still have this issue, which you have in many zones, of the difference between, which is the upper right-hand side chart, the difference between core goods inflation and core services inflation. So services is still sticky, and this is going to be the focus of the ECB in the next year or so. So we still expect further cuts from the ECB. We have our next cut priced in for December, and then we have steady interest rate cuts every meeting next year. So it's a more gradual path than for the United States. For the United States, I should have mentioned this earlier, we did change our call recently. So now we have, our call is that the Fed will cut by 50 basis points today. Although it's a judgment call, it's still, you can see the arguments for 25. And then they will cut by 50 basis points the next meeting, and then 25. So around 125 basis points of cuts for this year, potentially only 100, but within that ballpark. So our view is on the US that the focus is more on the labor risks that I mentioned. And so you're less worried about inflation risks, labor costs are low, core CPI has come down. The balance of risks has changed. So you're focusing on the other mandate more than the inflation mandate. You're focusing on the full employment mandate. So if you're doing that, that means you should get to neutral as quickly as you can. And so that's the argument for doing these rapid rate cuts. The argument against it is that, well, it may spook markets and people that cutting 50 basis points, is that a sign that things are really going wrong? So I think the communication part of it is still a challenge, but you can communicate that you need to get to a neutral stance quickly, and this is why you're doing it. So I think it'll be interesting to see what the Fed does today and how they communicate it. So as in elsewhere, the last mile of the disinflation, as we call it, is the hard part. How can you get sustainably down to 2? And a large part of it will be related to wage growth. Wage growth has started to come off, but it's still at a high level when you take into account that productivity is very weak. So unit labor costs are still growing rapidly in Europe. So we have various wage models that we use, but in particular, German wage negotiations are tracked very closely, which is the upper right-hand side chart. But as you can see from the upper left-hand side chart, compensation per employee, the key employment variable, the most all-encompassing wage growth variable, has started to come down. It did actually come down a little bit below what the ECB expected in the second quarter, but a lot of volatility is created by German pay settlements and one-off pay agreements for inflation compensation. So those are really muddying the waters a little bit. But ultimately, wage inflation is still higher than in the comfort zone. But the expectation is that it will come off going forward. Now, in terms of other things which could cause problems, CRE has been a topic of conversation, particularly in the United States, as its impact on the banking sector. We don't think it'll have a big impact in the euro area. There are similar problems of property valuations coming down in office space, for example, in particular, and CRE in general. But the overall exposure of euro area banks to CRE is significantly less than in the United States. If you look at the upper right-hand side chart, you'll see that it's around 10% for most countries in terms of the bank exposures to CRE. In the US, it's much higher, which is in the table. It's around 25% CRE percent of loans. So it's much higher. And if you can look at smaller banks, it's close to 50%. The exposure of US banks to CRE is much higher than in Europe. So we have less concerns about CRE exposures in the euro area, although you will obviously like to get some stress and some non-performing loans, etc. But ultimately, you've got to remember that European banks are highly profitable right now. And the reason is the lower left-hand side chart. You'll see that net interest income has gone up dramatically, and it's just related to the higher interest rate environment that we're in. The interest margin has gone up. The deposit beta is quite low. So the net interest margin is basically driving net interest income growth in euro area banks, although that is expected to turn as we go forward, but still remain reasonably strong. So banks in Europe, in the euro area, look particularly healthy. You've had a significant decline in non-performing loans, which is the lower left-hand side chart, particularly in countries like Italy, for example. Common equity Tier 1 ratios are very healthy levels. There's significant buffers that most banks have. Liquidity coverage ratios are also high. So overall, it doesn't look like any major stress in euro area banks. You need a massive shock really to cause them stress. Fiscal is important. People are focusing on the fiscal situation in Europe. I'm not going to go through this. It's quite a detailed table. I think the bottom line is there's some new EU fiscal rules coming in, and you will likely get consolidation going forward in Europe. We don't think it's going to be dramatic. We think that maybe the fiscal impulse will be negative by about 0.5% of GDP in the coming years. So it will be a little bit of a drag, but it's not going to be a dramatic one. It should be offset by private demand picking up if consumption does pick up as we expect. So overall for the euro area, we have a similar soft landing scenario. We have GDP gradually picking up. So we have our estimate of potential around 1. So it's not a really strong pickup, but it is going towards trend. We have the unemployment rate flatlining, basically. And we have headline inflation and core inflation gradually normalizing to around 2% by the middle of 2025. So it is a fairly immaculate disinflation. You're not getting a significant growth loss. And I think the difference, say, with the US is the growth has been much stronger in the US. So it's decelerating from a higher level. In the euro area, it was pretty weak in 2023. And it's been gradually picking up a little bit, although there's still some concerns about weakness going forward. The difference is the labor market, which is the flip of the weak productivity, has been stronger. So we haven't seen any tick up yet in the unemployment rate. So that's really where the labor weakness argument isn't as strong as in the euro area as it is in the United States. Elections have been a big focus. Obviously, we talked about the US election. There's been EU elections as well. Really didn't really move the needle, I don't think. And so the Draghi report, we'll see. A lot of the measures is a real call for action. The question is, will that action happen, given the institutional structure and the difficulty of some of these reforms? So the political right did increase its vote in the June parliamentary elections, but probably a little bit less than people expected going into the elections. So the von der Leyen's party, the EPP, actually did better than it did in 2019, which was a little bit unexpected. So there was a rise in the vote for the right-wing parties, ECR and ID, but not as great as people expected. And there was already a decreased focus on the green agenda and more on competitiveness before the elections, as it was quite clear what the result would look like and what the changing priorities are. There's a lot of concern about the costs of the green transition that a lot of consumers are facing in Europe, and so there's been a little bit of a pivot. There is a big focus on leveraging private capital and enhancing capital markets. Given the fiscal situation I discussed, a lot of the investments needs that Draghi talked about, 750 to 800 billion through 2030, increasing the investment share by 5% of GDP, are going to have to come from the private side. And you need a more efficient capital markets union to do that. Making progress on it is going to be very hard. It's a slow process, so we'll see where that goes. But it's right to focus on those elements. France, we still have to see what the government Barnier can form, and there could be some volatility associated with that. We'll have to see how stable that government is. And in general, we think that more consequential for Europe will be the US elections versus the EU elections. So I think it's very important what happens in November. Very quickly, let's just talk about the UK since we are here. So the UK growth looks a little bit better than in the euro area. It's picking up. There's been a bit more momentum. The July GDP data was a bit of a pothole, but it could be just due to volatility. But overall, you're seeing, we've revised up our recent GDP forecast. Business confidence, which is a lower chart, the blue line has been strong for quite a while. Consumer confidence is also starting to pick up, although it's still below zero in terms of balance. But the underlying picture is a little bit worse than elsewhere, though it's been changing quite dramatically. The forward-looking indicators of inflation in the UK are getting better, but services inflation is still very high, and the data today confirmed that, came in line with expectations. But services inflation is still running above 5%. Core inflation is still running above 3%. So there's still the last mile still needs to be, there's still a last mile of the journey to go. A big part of what's driving service inflation in the lower right-hand side chart is really wage inflation. There's a very strong correlation between services and wage inflation. Now, supply side issues in the UK, big focus on this as elsewhere. Brexit had a big impact on investment, and you can see that clearly from this chart. The left-hand side chart tanked after the Brexit vote. But the labour productivity story predates Brexit. It goes back to the GFC, which is the right-hand side chart. Essentially, labour productivity has been on a much shallower slope since the GFC. So there's more than Brexit that is causing the structural problems in the United Kingdom. So boosting trend growth will not be easy. The government's right to focus on this, but it's going to be a challenge. As you can see, the OBR has been revising down its labour productivity path consistently. We are more pessimistic than the OBR about UK potential growth. The OBR has it at 1.6. We have it at 1 or below right now. So there's a bit of a gap there. And ultimately, a lot of the productivity trends will be driven by global developments. You do see a big spillover historically, which is in the table, between the US to the UK. So when the US does better, the spillovers to other zones. That also applies to the euro area. So if you do get a significant uptake of the AI revolution in the United States, that should spill over and have some gains for other zones as well. Now, in terms of the fiscal, the budget's coming up in October. We do expect to see a similar profile to what you've seen before. There will be a tightening. That was already in train before. We think the tightening on the fiscal side will be about 0.6% of GDP next year. This is a typical pattern you see after elections. You get a tightening first, and then maybe some measures taken further out in the political business cycle. So we expect that to continue. Obviously, there's some discussion about what measures the government will take, whether they change the debt rule, but overall, we do still expect a tightening over the next year or so. So the outlook for the UK, it is getting a bit better. As I said, we've been revising up our growth forecast a little bit, certainly through 24. We do still have a deceleration in 25, given the high interest rates and the lags in monetary policy transmission, although I'd say there's probably some upside risk to that. CPI gradually comes down. inflation, not quite the same pace as in the euro area. So we have a more gradual pace of cuts of the policy rate. The next cut we expect to be in November, not this Thursday, but it could depend on what the Fed does, obviously, today. And then we have a gradual sequence of cuts by 25 basis points per quarter. So you get down to 3.75 by the end of 25, which is higher than our current expectations for the euro area or the US. So I will stop there and take any questions that you have.
Thanks for the info. I just wanted to ask, do you not see the inflationary factors that the markets have been worried about keeping the Fed in line with a single cut? Or do you think those have dissipated and they've got room to cut as they need to?
Well, I think there's two parts to it. I think markets have moved, actually. As Andrew was saying, they're 70% pricing in 50 bips, and this moved dramatically late last week. I mean, the inflation part of the picture looks a little bit more reassuring in the US. As I was mentioning, core CPI has come down. Momentum-wise, three month, as we look at the more near-term dynamics, looks good. It's come closer to 2. On a year-ago basis, it's still around 3. So that is a little bit of a concern. There's still a little bit more to go. I guess the bigger concern is that if you do start cutting rates rapidly, will that, if you just get a mid-cycle, you still continue the mid-cycle expansion, that may keep inflation pressure reasonably high. So it may be harder to get down to 2%. So you can imagine a situation where they make a few cuts, and then they have to keep interest rates still in restricted territory for a while longer. So, I think, yeah, I mean, it's we had that, too darn hot scenario. We put less weight on that now. You can't rule it out, but it does seem a low probability event, given that you're still in highly restricted territory. So even if they do cut rates by 50 bips today, they'll still be restrictive. So you wouldn't necessarily need to increase rates to keep them restrictive.
Thanks. Good morning. Hello. I have a question. In your analysis and your forecasting, how do you actually build in a factor for potential escalation of the war in Ukraine and how that would affect inflation going forwards? Because surely that could be a major factor in the next 12 to 18 months.
I mean, there's various scenarios you can think about for the war in Ukraine, right? A lot of it, some of it will potentially depend on what happens in the US election. I think Europe is preparing for maybe having to step in a bit more and providing more aid, both military and budget support, if the US does have a change of government and their appetite for continuing support to Ukraine decreases. But overall, if you look at it in terms of commodity prices, I mean, commodity prices have come off considerably during the war, right? Oil prices are now a little bit lower than before. Gas prices have been going up recently, but they're way above the 2022 peaks when it was close to 200 per megawatt hour. Now it's around 40 or so. So there's other factors which drive commodity prices. It's global demand. It's also what's happening on the supply side. For example, there's much greater production coming on the gas side from the US and also Qatar. So it's not a clear no-brainer what will happen with commodity prices. Now, in terms of your broader question, what could be the impact on Europe? Obviously, it depends on what you get. Whether you get an escalation, you just get a similar situation to what you have now and it dragging on, or you get some kind of agreement to have a ceasefire. So all those scenarios are still possible. I think the bar for reaching agreement is quite high because, Ukraine and Russia need to align in their objectives. And that's still a little bit apart. I mean, Ukraine will certainly want guarantees of its sovereign integrity of its borders. And the question is, how would you provide that, no matter what the change in the borders actually is eventually? But no, there's a lot of wild cards still. What happens there? What happens in the Middle East? What happens in the US election?
At the risk of exposing my ignorance, up to fairly recently, an inverted yield curve was seen as an indicator for a recession. And the SAM rule is not featured as much in sort of the last decade. Is it just not that our previous indicator is not working and we found a new one?
It's an interesting question. I still think there is actually a lot of value in the term spread, which is what you're referring to, right? The difference between typically you can do it, 2 year to 10 or 3 months to 10. So I think there's still value in that, but it's not a perfect indicator. I think you got to understand the mechanics of what's driving that term spread. Is it that interest rates have just gone up significantly at the short end, or is it more that you're worried about a recession further out, so your longer term rates have come down? So you've got to look at what the drivers of the inversion is. Similar for the SAM rule, you've got to see what's driving that unemployment rate to go up. Is it job destruction, which is more concerning than an increase in participation? So I think it's good to look at these signals because they have got some predictive property, but they always come with caveats. So you cannot follow them slavishly.